Hello and welcome to this week's Montgomery Minute for individuals. All right, here we are approaching April 15th and need to file soon and you need looking for a deduction, a last minute deduction. Okay. So December 31st has already passed. So that closes the opportunity to create a lot of deductions. However, there's one deduction that's available right up until April 15th, and that's the good old traditional IRA. So we hear about two types of IRAs, traditional IRA and Roth IRA. Traditional IRA is the one we get to deduct. Okay, Roth IRA, we don't deduct that. So I'm going to focus my presentation today, this week's Montgomery Minute, on the traditional IRA. So we can fund that thing up to $7,000 all the way up to April 15th. If we're 50 and under, if we're 50 and older, we can fund up to $8,000 into that traditional IRA. Okay, so let's take a quick example. If you're married filing joint, both spouses over 50, both spouses can put 8,000 apiece in there, $16,000. In this example, let's assume they're in a 25% tax bracket between federal and state, okay, which is reasonable. And so that would be a $4,000 savings on taxes by basically sticking $8,000 each into their own retirement account, okay? So it's a wonderful deduction that's available, right up until April 15th. Where can you set one of these things up? Any financial institution. You can go to your bank or credit union and set up a traditional IRA on the spot. It's almost as easy as going in and opening up a bank account, okay? And you can do that right up until April 15th, and then you can claim that deduction on your tax return when you file it, okay? Let me talk about some limits, okay? So you can run into limits if you're a W-2 employee and your employer offers a retirement plan, whether or not you even participate in that plan, okay? That can affect you. So if you look at your W-2, all right, there's a box on there that says retirement plan. If that box is checked, that means your employer offers a retirement plan, okay? That can then impact our ability to fund and take a deduction for a traditional IRA. So let's again take an example. Okay, let's say you're single. Okay, you want to fund a traditional IRA, but your employer, that box is checked on your W-2. Okay, so the income limits are once you get to 77,000, that deduction of a traditional IRA is fully deductible. Once you go over 77,000, it starts to phase out. By the time you're at 87,000, it's all the way phased out. Okay. For married filing joint, those numbers are kind of similar, and depending on one spouse employer has a retirement plan, or both spouses employers have a retirement plan. They're kind of similar numbers, just combined. So if both spouses are covered by a plan, then it goes to 123,000. It's fully deductible. By the time you're at 143,000, the deduction goes away. Okay, so just keep in mind what those income limits can be if your employer offers a retirement plan. And once again, that's whether or not you participate in it. So even if you participate in it and you funded a bunch through a 401k plan, okay, you can still do a traditional IRA subject to these income limits. All right. So some interesting background on the traditional IRA. So keep in mind that Congress passed the Social Security Act back in 1935, and that's when everybody was excited and funding their own Social Security through their employer and things like that. That greatest generation, those next 40 years. But it was only 39 years later that the government started to realize that their Ponzi scheme of a Social Security system was going to go broke. So in 1974, so 39 years later, they passed the act that created the traditional IRA because they said we need to create something where citizens can begin to fund their own retirement, all right, and we give them a tax deduction for doing so. Thanks for watching this week's Montgomery Minute.